Michael Yoshikami, founder of YCMNet, joining us on the line. In fact, Barron's called him one of the top 100 independent financial advisors last year, and he joins us from Newport Beach. Okay, Michael, so you just heard one investor saying things are looking choppy. You said that. It looks like the market, it looks a bit soft these days. What about these declines that we saw in Europe, some heavy losses, and also that drop on Wall Street?
Well, first of all, choppy is the easiest call in the world to make. I think the markets are going to continue to be very choppy. And I think that as the problems get sorted out in Europe, I think the markets are going to be under pressure. I don't see any real positive catalysts right now. I think that has been said by many analysts. Earnings have really exceeded expectations, but we're really running into a bit of a buzzsaw in here that we not only have what's happening in Europe, we also have China tightening at the same time, which could very well slow down that economy. We have a very, very tepid recovery in the United States, and frankly, you could very well make the case that earnings have caught up with the stock market at this point. So I don't think we're really coming off really cheaply valued numbers right now. So I expect it to be a tough time for investors. One needs to be pretty defensive right now.
Yeah, it sounds like there's a lot of headwinds in the market these days, Michael. So when you say, I guess, investors need to be careful, what does that mean? Does that mean selling off right now, getting into cash, or would you say, just watch it for the next few weeks or so?
Well, what I think investors should do is, first of all, if they have cash already, this is going to provide opportunities to go in and bottom feed. You know, this is going to be like a lemming pullback where everything is going to move down and maybe everything shouldn't be moving down. And secondly, I think that if you're currently invested, I think it's time to really take some of the profits out of some of the beta names, some of the names that have rallied significantly, and go into more cash flow-oriented names. In the United States, for example, fairly boring names like Johnson & Johnson. And I think there also are opportunities in companies that really, I think, have too much negative sentiment associated with them. One example of that would be, I think, General Electric, where the financial unit is really weighing down the entire company's stock price. So I just don't think it's time to go out on the edge and be buying high PE, high leverage beta names right now with all this uncertainty. Remember, we have the stimulus programs around the world are all expiring in the next 2-3 months, and you know, when economies come off life support, we're going to have to see how they are able to handle running on their own. So that's an uncertainty that's facing the market as well.
Yeah, so Michael, sounds like you're saying this is not a time to be brave. Let me ask you, the last time we spoke was on that 1,000-point drop day on the Dow, and you said that markets might fall another 8% or so in the next week. What's your call going forward? I mean, what are we looking at? Maybe 10%, even more declines for the next few trading sessions, next weeks?
You know, I think the markets are going to continue to fall, and I don't think we're looking at anything. I saw a headline the other day that said the Dow, for example, is going to fall to 7,000. I don't think that's in the cards unless something dramatic happens. But I think the markets are going to be soft. I think they're going to continue to fall. I just don't see right now that there's any real positive stimulus on the upside. I don't know what surprise we could possibly have at this point. The economy is already getting better in the United States, and that really isn't making much difference when you consider Greece and maybe Portugal and Spain are blowing up, and you have calls for maybe the euro coming to an end. So I think it's going to be soft going forward. I think there's going to be even better opportunities for investors when the markets drop here a bit.
Okay, and what are you watching out for closely? How do you know when to actually get back into the markets here and buy in and go long again?
That's a great question. I think it's a valuation issue. I think it's first of all, time horizon and valuation, and I think that you just have to do your valuation numbers. If you look at the price-earnings ratios of the stocks that you're investing in, and more particularly, not only the price-earnings ratio, but where they're getting those earnings. For example, if you buy U.S. companies, you're buying into an economy that might grow at 2% a year. However, if you're buying into a company, let's just say like McDonald's, it gets a tremendous amount of their revenue overseas, China, for example, you're probably buying revenue growth that's even higher. So I think if you're buying stocks that have reasonable PEs, but make sure you know where the E is coming from, it needs to be from emerging market countries.
All right, Michael, thank you for sharing your time on your Sunday evening. That's Michael Yoshikami, who's the founder of YCMNet Advisors, and he was joining us on the line from Newport, California.